Welcome to today's deep dive, where we're going to take a look at the U.S. stock market this week.
Yeah, it's been a crazy one for sure. Investors are, I'm sure, feeling it.
Definitely feeling it. And one of the big stories, obviously, has been Nvidia. Yesterday, the chip-making giant took a pretty big tumble. But today, it seems like they're bouncing back a bit. So what's the deal with these wild swings, and what does it potentially mean for the tech sector more broadly?
Well, you're right to hone in on Nvidia, I think. Their performance really reflects just how volatile the semiconductor industry is right now. This week's dip was mainly because of ASML's earnings report, which honestly fell short of a lot of people's expectations. And as you know, they're a major supplier for these chip makers like Nvidia. So when ASML doesn't do well, it kind of ripples through the whole sector. I think it's a good reminder that, global supply chains are really interconnected. Things happening on one side of the world can really impact how investors are feeling on the other side.
So yesterday's dip for Nvidia, that was like a knee-jerk reaction to some broader concerns in the industry. But then this rebound that we're seeing today,
Yeah.
does that suggest that maybe investors are feeling a little bit more optimistic?
Yeah, I think that's a good way to put it. Short-term volatility like this, it's pretty common in tech, especially with a company like Nvidia. They're really on the cutting edge. And, this rebound might mean that some investors see this dip as a buying opportunity. They're betting on that long-term growth potential. But it really, I think, just highlights how important it is to look beyond these day-to-day fluctuations and, think about the bigger picture when you're making investment decisions.
Right. And speaking of the bigger picture, earnings season is in full swing right now. We've got companies from all different sectors opening up their books and, revealing how they fared. Are we seeing any overarching trends emerge from these reports? Or is it kind of a mixed bag of results?
Yeah, it's definitely a mix, but there are some bright spots for sure. Like United Airlines, for example. They blew past their earnings estimates. And they even announced share buybacks, which usually means they're feeling pretty confident about their future. It seems like certain sectors, like travel, which obviously was hit hard during the pandemic, might be bouncing back even stronger than people thought.
That is encouraging news, especially for anyone who's been following, the travel industry and their rebound. But you mentioned it's a mixed bag, so I'm guessing not every sector is seeing this kind of boom. Where are companies facing some headwinds right now?
Yeah, you're absolutely right. It's not all sunshine and roses out there. We've also seen companies like CSX Transportation. They recently reported earnings and revenue that were lower than expected. And of course, investors were not thrilled about that. This could be a sign of
No?
the broader economic uncertainty that's out there. Things like inflation and potential slowdowns. Those things are going to weigh on certain industries more than others. I think it just reminds us that even when you have a generally positive earnings season, there are always going to be those outliers, those potential warning signs that we need to keep an eye on.
It's fascinating to see how all these different sectors are sort of navigating this current economic landscape. Some are riding high while others are facing those headwinds, like you said. But one thing that seems to be on everyone's mind is interest rates. The rumor mill's been buzzing about a potential rate cut. So what's the latest there, and how's that impacting how investors are feeling right now?
Yeah, the possibility of a rate cut next month by the Fed, it's definitely got people talking. And there are a few things kind of converging to make that seem more and more likely. One of the big ones is that we have seen inflation cooling off a bit recently. I mean, it's still a concern, don't get me wrong, but the pace has slowed down. And that gives the Fed a little more room to maneuver when it comes to monetary policy.
So if inflation were still super high, a rate cut would be riskier, right? But now with inflation cooling down, maybe the Fed has more flexibility to try to encourage some growth.
That's the idea. It's a real balancing act. And another thing the Fed's keeping an eye on is what's happening with the global economy. There are signs that the European Central Bank, they might be getting ready to cut rates themselves. Growth has been slowing down in the Eurozone. And central banks tend to watch each other pretty closely. Their decisions can really have a ripple effect.
Right. It's like they're all doing this delicate dance, each one waiting to see what the other one's going to do.
Yeah.
But how are investors here in the U.S. feeling about this potential rate cut?
Well, generally speaking, lower interest rates are seen as a good thing for the stock market. And we've definitely seen that reflected in how the market's been performing lately. Lower rates can make it cheaper for companies to borrow money, which could lead to more investment and expansion. And there are certain sectors, like utilities and real estate, they rely a lot on debt financing, so they're particularly sensitive to interest rate changes. And those sectors have been doing pretty well lately, maybe in anticipation of a cut.
So a rate cut could be good news for some parts of the market. Sounds like it's really important to remember that the impact can be complex and vary depending on the sector. Now, you mentioned something earlier that I wanted to circle back to, the performance of small cap stocks. They've been quietly outperforming the larger companies, which seems like it might be a sign of something interesting happening. Can you tell us a little bit more about that? What's driving that surge, and what does it tell us about the broader market?
Yeah, you're right to pick up on that. How small caps are doing is often seen as a good indicator of the overall health of the economy. And the Russell 2000, that's a key benchmark for small cap companies. It's been on a tear lately. Actually, it's on track for its highest close in 2 years, which suggests that the market rally we've been seeing, it's not just about those big tech giants. It's broadening out.
So instead of just a few companies pulling the market higher, we're seeing more widespread participation,
Mhm.
including from those smaller companies.
Exactly. And that's generally seen as a positive sign. It suggests that the recovery might be becoming more broad-based and that investor confidence isn't just limited to a handful of big players. Definitely something to keep an eye on.
It really is encouraging to see those signs, that the market rally is becoming more broad-based. But like with anything in the investment world, we've got to stay on our toes, right?
Yeah.
What are some of the things that you're keeping a close eye on in the coming weeks and months? What are some of those potential challenges or shifts that we should be thinking about?
Well, you're spot on about staying vigilant. One thing I'm really watching closely is the retail sales data. Consumer spending is such a huge driver of the economy, so any big changes in how consumers are behaving, that could have ripple effects across the board. If we see strong retail sales, that's generally a good sign about the health of the economy. But if things start to weaken there, well, that could be a signal that there's some trouble brewing.
So it's not just about how companies are doing, it's also about how confident people feel about actually spending their money.
Exactly.
Are there other potential curveballs we should be aware of? I mean, things that might not show up right away in the market numbers, but could still have an impact down the road.
Oh, absolutely. I mean, we can look at all the economic data and market trends, but there are always those external factors that can shake things up. Like, for example, all those labor negotiations that have been happening in different industries. Depending on how those play out, you could see impacts on things like labor costs, corporate profits, even consumer prices.
It's a good reminder that the market doesn't exist in a bubble. It's part of this whole web of economic, political, even social factors. And speaking of unforeseen events, those hurricanes we've had,
Right.
those are another factor to consider. Natural disasters can disrupt supply chains. They can impact energy prices. And, those broader economic consequences can take a while to really understand.
Yeah, you hit the nail on the head. It's all connected. And events like these, I think they just underscore why it's so important to have a diversified portfolio. Manage your risk effectively, and maybe most importantly, take that long-term view.
That's great advice as always. You've given us a lot to think about today. Any final words of wisdom for our listeners as they try to make sense of all this and, navigate their own financial journeys?
At the end of the day, investing in the stock market always comes with risks. Past performance is never a guarantee of future results. So, do your research. Think carefully about how much risk you're comfortable with. And if you need to, don't hesitate to reach out to a financial advisor, someone who can give you personalized guidance.
Sound advice. It's your money, your financial journey. And the more informed you are, the better equipped you'll be to make those decisions. Well, that's all the time we have for today's deep dive, but hey, here's something to think about. We've talked a lot about how different sectors of the economy are doing. But what about the art market? It seems like it's a world away from Wall Street sometimes. But could it actually give us some unique insights into broader economic trends? Just something to ponder as you continue exploring the world of finance. Thanks for joining us for another deep dive. We'll catch you next time.